Happy day everyone. This is Ashwini V, Assistant Professor, Department of Commerce, BCom Accounting and Finance. Today I am going to handle a topic related to income tax law practices 1 under old tax regime versus new tax regime for the salaried individuals. So the IT Act has provided two options, that is the old tax regime and the new tax regime for the salaried individuals. So here we have the old tax regime allows the various exemption and deduction, but in the new tax regime it offers a lower tax but with significant importance here. For the financial year 2025 and 26, the new tax regime provides a significant benefit where you have a reduced tax rate which comes to a nil rate if you have a income level up to 12 lakhs. So how to choose between a old and new tax regime here? So it all depends upon the tax exemption that you have and the deductions that you have. And along with it, you need to calculate the tax liability under both the regimes in order to find out where you lie on a possible manner. In order to choose the regime with a lower tax liability, you need to inform the employer. So based on that, the TDS calculations will be made here. Along with others, you also need to assess what is the loss you are incurring from the house property and the gains that you are receiving from the capital assets and any kind of a business income. So with that, we'll have to look into what are the previous year losses that you have been carried forward. Usually, the losses can be carried forward for 8 subsequent years. The rebate has been increased to 60,000 from 25,000, which is a welcoming note. With the revised tax structure, individuals earning up to 12 lakh have a standard deduction up to 75,000, which is actually reduced from the last financial year. These are the tax slab changes for the financial year 2025-26, assessment year 26-27. So the income, as I discussed before, up to 12 lakhs for any kind of a salaried individual, it's going to be nil. Along with the standard deduction of 75,000, the income level will rise to 12 lakh and 75,000. So these are the modified slab rates under the new tax regime. So up to 4 lakhs it's going to be nil, 4 lakh to 8 lakh it's 5%, 8 lakh to 12 lakh 10%, 12 lakh to 16 lakh 15%, 16 to 20 is 20%, 20 lakh to 24 lakh 25% and above 24 lakh is 30%. So here I am going to just give you the beneficial regime based on what will be the better option, whether it's an old regime or the new regime. So here this particular column is going to be your income level and the first row is going to be the deduction that's available for you. It can be deduction in terms of an old regime or a new regime based on the investment, insurance policy, medical claims that you have taken up. So if I have an income level of 10 lakhs with 0 deductions, so in that case new tax regime will be beneficial for you. But as the level just goes up and the deduction also goes up, the old regime is always beneficial for you. Where there are notes where I have given actually both. So in those cases, it can be beneficial in terms of old and new tax regime also. In terms of salary income, under 10 lakhs to 17 lakhs and the maximum exemption of 7.8 lakhs here. So the current tax rates under the new tax regime, where we see what are the deductions that is available or not available here. So basically whatever we have claimed in terms of an insurance, in terms of an NPS, in terms of PPF are not available in terms of a new tax regime here. So that's what the several exemptions and deductions cannot be claimed in terms of HRA, LTA, ATC and ATD, which are mostly commonly claimed by all the salaried individuals here. The government has introduced 5 key important notes in terms of budget 2023, seeking that there are not many takers for the new tax regimes. So in those cases, we have taken up these 5 points in order to encourage the taxpayers to adopt the new tax regimes. So first one is the higher rebate limit. So from 5 lakhs, it has been increased to 7 lakhs. With an income up to 7 lakh, they will not be having any kind of a tax liability here. So the budget from 2024, the standard deduction for the salaried individual has been increased from 50,000 to 75,000. So your level of income from 12 lakh to 12 lakh 75. The limit has increased to 12 lakh 75 where your tax liability will be 0. With the revised tax structure, the taxpayer will be able to save 17,500 if his level of income is 7 lakh. So next is the salary income. The standard deduction has been increased from 50,000 to 75,000 with effect from financial year 2024 and 25, and the family pension. So we have a rule where those receiving a family pension, the lower amount of 1/3 of the total pension or 15,000 whichever is less. So this particular 15,000 has been increased to 25,000 with the new regime from the effect from financial year 24 and 25. Next one is reduced surcharge for the high net worth individuals. Those people who are actually earning income above 5 crores, their surcharge has been reduced from 37% to 25%, and this will definitely move on to the effective tax rate from 42.74 to 39%. This will actually be more beneficial to a super rich person who can actually claim the tax benefit here. Next is the higher leave encashment exemption. So this exemption limit has been raised from 3 lakh to 25 lakhs, which is actually a 8-fold increase. So this is more beneficial for all the employees who are actually claiming back all the leave encashments from their organizations. But the default regime has been introduced in the financial year 2023 and 24. So the new tax regime has been taken up as a default option with reference to the form 10IEA. Okay. So in this case, so all those salaried individuals who really want to take up the old regime but want to convert later, this form is necessary and has to be submitted to the employers also. So the deduction under old and new tax regime for the financial year 24 and 25. So as we discussed, the chapter 6A deduction is not applicable for the new tax regime. Only a certain part of it is taken into consideration, certain part of it is taken into nil consideration. When the deduction, so these are the three situations here. So when the deductions are 1.75 lakhs or less, the new tax regime is going to be beneficial. When the old tax deduction 4.5, then the old regime will be beneficial. So when the total deductions are between 1.75 to 4.5, we will depend on what is the better income level. Okay. So next, these are the exemptions and deductions which are not available under the new tax regime in 2005. So these are the non-claimable tax deductions and exemptions. So previously in the old tax regime, we were able to ask to submit all the investment proofs so that we can claim the deductions or the exemptions under the chapter 6A. But in terms of a new tax regime, we will not be able to do all these things. So what are the things that we were usually taking up but not available right now? Standard deduction under section 80 TTA and 80 TTB, this is regarding to the interest that you have claimed in the savings bank account. Deduction under 80C2, 80 DDB and EEA. So all these deductions are part of your insurance claim, your tuition amount, your PPF, your NPS. So these are the major claims that we are actually waiving off from this particular deduction chapter. The professional tax, entertainment allowance on salaries, HRA, LTA, children education allowance, minor children income allowance, interest on housing loan, self-occupied vacant property, other special allowances, employee contribution to NPS account, donation to political parties and help allowances. These were once a part of the older regime where all of us were beneficial, but right now it has been waived off from the deduction chapter. The provision for the exemption and deductions which are available right now in the new tax regime is the transport allowances with respect to the person with disability, conveyance allowances, travel allowances, perquisites in terms of official purposes, exemption of the voluntary retirement, gratuity, leave encashment, interest on the home loan only on the let-out property, gifts up to 5,000 can be claimed back, employees contribution to the NPS account, employers contribution to the employees NPS account, additional employee cost, standard deduction on the family pension, deduction on deposits in Agriwear corporate funds. So this is the comparison for you to show the deductions between the old tax regime and the new tax regime. So these are the available exemptions right now in terms of old and new. So as I was talking about standard deduction under section 80 TDB, the old regime had given us 50,000, but the new regime is giving us a 75,000. But yes, the deductions are available in both the cases. The employment and or professional tax, old regime is yes and new regime is no. House rent allowances, exemption on the food and beverages, deductions up to 1.5 lakh which was available with all the life insurance, NPS, PPF, that is available only with the old regime and not with the new regime. So the other part, the employees contribution to employees NPS account, it's available in both the regimes. Deduction under 80 CCDB up to 50,000, it's available only in the old regime. Medical insurance claim, which is the primary part of most of the middle class individuals in India, it was available only in the old tax regime but not in the new one. Last one, the interest on the home loan for the self-occupied and the let-out property is not available under the new tax regime. So in this case, how are you going to take up the decision based on what is better for you in terms of old tax or the new tax regime? In case you are a person who are receiving the salary from an organization or any other head of income, then you will have to make a choice to your employer based on the decision that you've taken in the financial year, or in between you have a choice where you can change only at the time of filing your income. Then your income from business or profession, the choice is between the tax regimes that can be made which can be more beneficial for you. For more such videos, like, share and subscribe M.O.P Classroom. Thank you.